We hit the streets of Kampala and asked a few people to share with us their opinion on saving for retirement. Hello, what is your name and what do you do?
My name is Yasin and I'm a fisherman.
Are you saving for retirement or do you plan to work in your old age?
I'm here to enjoy myself. Tomorrow will sort itself.
What if I told you that you can start saving for your retirement with as little as 1,000 Ugandan shillings daily?
1,000 shillings? You mean it's that cheap? I should start right away.
Old age is inevitable. It's on you to make your retirement enjoyable. Sign up with the Retirement Benefit Scheme licensed by URBRA today and start saving from as little as 1,000 shillings daily to live an enjoyable retirement. To find a licensed scheme for you, contact us on 0417 304 500 or www.urbra.go.ug. This message is from the Uganda Retirement Benefits Regulatory Authority.
We hit the streets of Kampala and asked a few people to share with us their opinion on saving for retirement. Hello, what is your name and what do you do?
I'm Brand and I sell matches.
Are you saving for retirement or do you plan to work in your old age?
Don't you have to be in an office for that?
What if I told you that you can start saving for your retirement with as little as 1,000 Ugandan shillings daily?
Where can I find them right now? I'm ready.
Old age is inevitable. It's on you to make your retirement enjoyable. Sign up with the Retirement Benefit Scheme licensed by URBRA today and start saving from as little as 1,000 shillings daily to live an enjoyable retirement. To find a licensed scheme for you, contact us on 0417 304 500 or www.urbra.go.ug. This message is from the Uganda Retirement Benefits Regulatory Authority.
We hit the streets of Kampala and asked a few people to share with us their opinion on saving for retirement. Hello, what is your name and what do you do?
My name is Jonah and I ride the border.
Are you saving for retirement or do you plan to work in your old age?
I'm only 23. What's the rush? I still have time.
What if I told you that you can start saving for your retirement with as little as 1,000 Ugandan shillings daily?
If it's only 1,000, then I don't have to wait. I can start saving now.
Old age is inevitable. It's on you to make your retirement enjoyable. Sign up with the Retirement Benefit Scheme licensed by URBRA today and start saving from as little as 1,000 shillings daily to live an enjoyable retirement. To find a licensed scheme for you, contact us on 0417 304 500 or www.urbra.go.ug. This message is from the Uganda Retirement Benefits Regulatory Authority.
I turned my collar to the cold and damp when my eyes were stabbed by the flash of a neon light that split the night and touched the sound of silence. And in the naked light I saw 10,000 people waiting, people talking without speaking, people hearing without listening, people writing songs.
We hit the streets of Kampala and asked a few people to share with us their opinion on saving for retirement. Hello, what is your name and what do you do?
My name is Margaret. I do mobile money services.
Are you saving for retirement or do you plan to work in your old age?
Do I look like I have that kind of money? I am too broke.
What if I told you that you can start saving for your retirement with as little as 1,000 Ugandan shillings daily?
Lukumiruka, even I can save for retirement.
Old age is inevitable. It's on you to make your retirement enjoyable. Sign up with the Retirement Benefit Scheme licensed by URBRA today and start saving from as little as 1,000 shillings daily to live an enjoyable retirement. To find a licensed scheme for you, contact us on 0417 304 500 or www.urbra.go.ug. This message is from the Uganda Retirement Benefits Regulatory Authority. Meet Daudi and Brian. They are both 30 years old and own businesses downtown. Their businesses have grown over the past few years and are doing well. Life is good and the future is bright for both Daudi and Brian. Let's check on Daudi and Brian 40 years later. Daudi has retired. These days, he likes to catch up with the news and receives his retirement benefit payments on his phone. He is not worried about money and is enjoying his retirement. Brian, on the other hand, owns a small kiosk and rents a small bedroom house. He's broke, sickly, and stressed. You must be wondering what happened. Daudi joined a savings scheme as soon as he started making money. Even when things were bad, he tried and put at least 1,000 shillings a day to his retirement account because he was determined to retire in peace. Brian, meanwhile, did not think saving for retirement was a priority. He always thought that his savings account was enough. A few years ago, he made some bad financial decisions and lost all his money and investment. He cannot retire because he doesn't have any savings. Old age is inevitable. It's on you to make your retirement enjoyable. Sign up with the Retirement Benefit Scheme licensed by URBRA today and start saving from as little as 1,000 shillings daily to live an enjoyable retirement. To find a licensed scheme for you, contact us on 0417 304 500 or www.urbra.go.ug. This message is from the Uganda Retirement Benefits Regulatory Authority.
Listen to me, my child. Learn from me. You're young, you're strong, but one day you'll grow old. Don't make the same mistake I did. Start now. Start saving for your retirement.
Don't wait for life to get tough. Start saving for retirement and live better in the Zabu life. Zabu Life. Happy retirement. A message from the Uganda Retirement Benefits Regulatory Authority.
Choose a better retirement. Save a little from what you earn while you still have energy to work. Look for a retirement benefit scheme licensed by the Uganda Retirement Benefits Regulatory Authority, URBRA, and start saving money for your old age, whether you're employed or self-employed. For more information, call 0417 304 500. This message is brought to you by Uganda Retirement Benefits Regulatory Authority.
Hello. Good morning. Good morning, ladies and gentlemen on the call. You are most welcome, and thank you very much for choosing to spend your time with us this Friday morning. I welcome you on behalf of the Uganda Retirement Benefits Regulatory Authority to this very webinar promising to be very informative and insightful. My name is Lydia Mirembe. I'm the Manager Corporate and Public Affairs here at URBRA, and I'll be your moderator. I have put on my video just to give you the assurance that there is a face behind the voice, and it is not a bot speaking to you. In the era of AI, almost anything is possible. So here I am. I'm happy to be hosting you this morning. Happy Friday. Before we get into any further business, I'll just call us to say a very short word of prayer, as is the culture. to dedicate our webinar to a higher authority. And I'm happy to say the prayer, not because I'm holier than anyone, but because I don't want to volunteer someone. So let's have wherever we are, and I'll pray. Thank you, Father Almighty, for bringing us together this Friday morning. Thank you for the gift of life. We pray that everything that we say, everything that we do, everything that we think, and everything that comes into our deliberations will be guided by you. May we take away lessons that we can apply to the betterment of our lives. We pray in the name of the Almighty. Amen. Yes, once again, good morning. This is the URBRA monthly webinar where we interact with you, our dear stakeholders, to discuss key issues, key matters that concern not just the sector, but the savers. Because as you know, this sector, without you, the members, you, the savers, this sector comes to naught. So it's always an opportunity to interact with you, and we're happy when you make a date with us and spend 1 or 2 hours every month sharing with us your experiences, your expectations, asking us questions, and making sure that as far as retirement planning and saving is concerned, we all have a common vision. This morning, by way of setting the context, you have seen on the flyer our topic, who watches over your retirement benefits? We want to dissect the role of URBRA, the Uganda Retirement Benefits Regulatory Authority, in protecting not just our retirement benefits, but in essence, our future. Because the future is there. The future is where we shall end in retirement. After doing so much good work, we need a good and comfortable retirement. But as we walk that journey, who is watching? Who is watching? And that's the basis for our discussion this morning. URBRA, the regulator, the one that watches over your retirement benefits and all the aspects that relate to your retirement benefits. Just to put it in context, we may all be aware, or some not, that this sector is one of the one that's really growing fastest in Uganda. Sometimes you listen, maybe on the radios, on the TVs, usually around September, when declarations are being made and you hear trillions. This fund has grown to these trillions. The sector has grown to so many trillions. Now we are at over 30 trillion assets under management. And all of these are funds saved by Ugandans. And the numbers keep growing. Now we have over 4 million member accounts. And we're happy to save. Some of us, we save forcefully because it's by law. Others, it is voluntary. And that voluntary portfolio is really growing. That means that many of us now appreciate. We appreciate retirement saving. We appreciate that somewhere along the way, we shall become too weak and less productive, and we shall need a soft landing. And that soft landing will mostly be provided by our saving. So there's that great appreciation. But we've also come to realize that even as we save, there are many things that we do not know concerning our savings as members. Who is, for example, making sure that our funds are well invested, that the choices our fund managers make for us are in our best interests as members. You know, who is looking after our funds? Who is taking decisions and why? And at the end of the day, how does it come down practically to me as a member? How does it speak to my pocket when it comes to retirement income? And many times you get questions, somebody really asking what seems to be naive, but it's a very serious question of what is URBRA? What does URBRA do? How can I start saving with URBRA? Many people think URBRA is actually a retirement savings scheme. These seem very simple, but they are very important questions because one way or another, they affect you, the saver. The decisions that are taken in these frameworks, regulatory, policy, legal frameworks, ultimately, they are to ensure that you have a very good outcome as a saver when your time comes. So this morning, we're going to delve into that and understand how URBRA ensures that our retirement savings are not just safe and secure, but that they really give us the retirement that we are looking for. At least they give us a good starting point when we finally come of age. What is the role of URBRA? Where does URBRA come in? That's going to be our discussion this morning. And I'm happy to let you know that we'll have none other than the Chief Executive Officer of URBRA. We wouldn't have a better person to dissect this for us than the man in charge, the CEO of URBRA, Mr. Martin Anthony Suruga. While he's the CEO of URBRA, he's got very many credentials behind him, and that really makes him the best person to tell us, to give us an impression of where URBRA has come from, where it's going, where it's taking us. He's technically and professionally been behind the formulation of policies and regulations that set off the sector reforms that have brought us to this sector worth 30 trillion. He's been very instrumental in the development of pension sector policy development and contributed to most of the regulations that I've said and all the regulations under which the URBRA Act was developed and under which it is being operationalized. So that is the CEO, and he's the one going to really take us to that granular level. As we go along, I welcome you to share your views, your experiences, your questions. Do not leave this place today when you are not very well informed of what exactly the sector regulator can do for you to ensure a very good outcome when you finally retire. I welcome Mr. Nsubuga. On this note, I'd like to recognize the presence of many of the directors at URBRA who have logged in. I think they'll also be throwing in a message or two in the chat boxes. I can see the Chief Manager of Corporate and Public Affairs. These are the affairs that come from the public. They are the ones that give us what to talk about. So I welcome Haji Nakabali and all the other colleagues online. If a question comes in, please just send an answer or response in the chat, and our members on the call will be able to follow. But for now, I'd like to invite Mr. Nsubuga to share with us what he has prepared for us. And may we all enjoy as we partake of the package he has for us this morning. Over to you, Mr. Nsubuga.
Well, thank you, Lydia, for that introduction. Can you hear me? Just to confirm and to test.
Yes, please. We can hear you.
Okay. But here they tell me the host isn't allowing sharing for this webinar. What can I do? Can I be allowed to share?
Let me ensure that.
I'd prepared the presentation, which I'll show, a brief one, which I want to guide the discussion.
Let me ensure that you are enabled to share.
Okay. In the meantime, I can probably give a little background.
Yes, please.
Good morning, colleagues, and good morning, our dear hosts and our dear guests who are really joining us in this conversation, which is very dear to us. Many things have been seen all over in our publications, in the media, the good things that we've been able to do, the achievements that sector has registered, and the things that we think are feedback. And the things that we've been able to deliver for the members of the sector and the sector at large. But it all starts with it's basically having a meal on the table and you don't know what happens in the kitchen. Very nice meal, you celebrate, but you really don't celebrate the chef or the cook. And today we just want to share with you what we do behind the kitchen to deliver you the best meal. So apparently, I'll dive in quickly. I think I can still start irrespective of the presentation. Sorry, irrespective of the sharing which is being worked on. First and foremost, URBRA was established by an Act of Parliament of 2011. And prior to URBRA's establishment, there was a journey of the pension reform in this country, which started way back in 2002, 2003. But I only speak to the main objectives for the pension reform. The first one was to improve the scope and efficiency of the retirement benefits provisions. And that in it was look at widening the scope to see that there is a wider coverage, which I also want to say that we've achieved little into that, but to improve on the efficiency, which we've been able to deliver, as I'll share with you shortly. The second one was to protect members' funds, and that's where most of our energies are being directed. And if you look at even our drivers or the tag that speaks to what we do is protection of members' funds, members' retirement savings. Largely, that's what informed and drives the big check. Just hold on. Okay, thanks. I've been assisted to share. Just give me a minute. Okay, can you see the screen, guys? Lydia, can you confirm whether you can see the screen?
Yes, please. We can see the screen. Thank you.
Okay, fine. So I was just running through the pension reform objectives, which are largely four. The fifth is secondary objective. But the first one was to improve the scope and efficiency directed, ensure that members' funds are speak to you in a few slides, and that has formed the foundation of the supervisor and the retiree regime that today we. The third one was to ensure stability in the sector, but not only stability and integrity of the retirement benefit sector, but also the financial sector at large. I could see the integral relationship between the financial sector and the pension, largely on the depth of the pension sector in terms of assets under management and where they're invested. That speaks volumes over the stability and integrity of the financial sector. The fourth one is to ensure the adequate, affordable, and sustainable pensions for retiring Ugandan labor force. And again, I will try to speak what we've been able to deliver and what we've not been able to deliver. The four were largely to drive the long-term savings mobilization to facilitate the long-term economic growth and transformation. Unfortunately, in many circles, they tend to promote the secondary objectives more. But today, I just want you to appreciate that why we're here is to protect your funds, your savings as a member, and to ensure efficiency, but also to widen the scope, but importantly, to ensure stability and integrity of the sector such that you can have confidence in us and in the sector and have trust in us. Okay. Why is this cursor not responding? Okay. Now, the second consideration that I thought I needed to bring you to speed is what we are regulated to do, or what we are allowed to do. What is our mandate, which is enshrined in the act that I mentioned earlier. I've clustered them in 6 areas, but largely the biggest drivers are to regulate the establishment and management of all schemes in this market. We supervise them to ensure that they adhere to the set standards and the requirements therein. We protect, like I've said, that's the biggest driver, and that's largely why we are paid. And even the supervision and enforcing of regulation is largely to ensure protection. Fourthly, we license. You cannot operate in our space without a license. And that's the first shield that we really use and to articulate. If you are operating without a license, then we whip. There are legal provisions for that. So the first entry point to be a scheme must be licensed, and subsequently those you work with must equally be licensed. The other two are largely implementing policy as spearheaded by government and work hand in hand with other stakeholders. That's the Minister of Finance and the Minister of Gender, Labor and Social Development on the subject of social security in this market, but to also advise our mother ministry to see that we grow the sector and also try to progress and create an impact. So largely, that's what speaks about us and what we are licensed to do. But I thought I needed to quickly dive into the structural landscape of the Ugandan retirement benefit sector. Currently, we have 65 licensed schemes. It is a big number from 2 or 3. Today we are talking of 65. And of those, 47 are voluntary occupational schemes where you and I keep your money in addition to what is mandatory under the NSSF. But we've also seen a growth in enrollment of participating employers, those who have opted to work under participating employers and under umbrella rather through participating employers. And we've seen a positive response of close to 270 participating employers who have opted to register their staff under an umbrella, and they're creating value for them and enhancing the savings that are already being saved with NSSF and then enhanced with additional contributions through the employer. But also, since voluntary savings numbers are also very encouraging, not yet at a faster speed as we would have loved, but yes, they're encouraging. And I am proud to say that we are happy with one of our voluntary scheme that we started in its infancy, that is the Mazima Retirement Benefit Scheme. But there are 2 employer-based mandatory schemes which I thought I needed to articulate, and that is the Parliamentary Pension Scheme and the Makerere Universal Retirement Benefit Scheme. The scheme cannot operate without trustees, and we demand that all trustees that who operate or who oversee. Trustees are the boards of directors who carry the fiduciary duty to oversee the operations of the scheme and subsequently onboard any service providers. They actually have the strongest weight in the oversight of the scheme. And today, we have 224 trustees. Those are the current ones. But those that have been licensed, they're close to 1,000 since we're established. Remember, a person has a limit of service. They cannot serve more than 2 terms. There's also a limitation to that. So the ones I'm referring to, the 224, are basically those who are in active trusteeship. We have 14 external auditors. These also play big role to give us comfort that the financial statements reflect the true positions of the scheme and they're free from all material misstatement. And subsequently, we can, with confidence, give the assurance to the member down there that your money has also been audited by a professional and they've given an opinion to that. We have 8 administrators who support in the day-to-day operations of the scheme. Those schemes who have opted to have an outsourced administrator, but also have others that have opted to have in-house administrators. You may realize we have 65 schemes and we have 8 administrators. You can just imagine the weight they have for those who have opted to have outsourced administration. So the very important engine in our function, because they oversee quite a number of schemes. I think each administrator has an average of around 5 schemes over their oversight as a minimum. Then you have 7 fund managers and 7 custodians. These are the professionals who ensure that the money, your money, is invested prudently and professionally and have to adhere to the set defined asset classes, which the regulators define. No any other asset class are you allowed to invest in members' funds, and that also has helped us to protect the members' funds. So largely, that speaks to the landscape. After articulating the landscape, then we can dive into, a synopsis of how the sector looks like today. As of end March, this is the statistics we have. Your members have saved 35.5 trillion. And remember, this figure is rising from 33 as of December. So the exponential growth is still on. The momentum is still excellent. Of that, we have NSSF, which has around 30.5, and they account for 86.2 of the total industry assets under management. But it's also important to recognize the exponential growth of occupational schemes, almost hitting 5 trillion. In one of the discussions I've made in the past, in 2012, 2013, the sector had assets under management of around 4.6 trillion in 2012. So you can imagine what has happened in 12 years. So when you see the occupational schemes at 4.9, you can just imagine the momentum. Quickly, you are doing very well and you are really saving. The sector is growing very well and there's significant compliance, and that's why we are at this level. I'll show you where the breakdown of this money shortly. But I thought it was also important to share with you the regional presence of our money, of your money. This money is largely invested in the region as it is required. All the money has to be invested in the East African region. The largest shares, of course, in Uganda, 68%, Kenya, 23%, Tanzania, around 9%, Rwanda, just less than 1%. So the presence is all over, and that means we need to be mindful of the risks, the regional risks, in the event there are those issues that happen. Like we had one in Kenya, the elections, and had the exchange rate issues and the interest rates. Yes, they affect us, but that's what we are paid to do, to monitor the trends, the macroeconomic trends, and be able to provide oversight and then galvanize the value and protect your funds. So how do we ensure that all this money is well invested? And I think I needed to dive into our supervisory oversight. I've clustered it into 7 layers, and I'll spend a little time speaking around this. First, we set the standards. A number of regulations have been set and guidelines, and many of them inform the process of licensing, the process of scheme administration, the process of scheme management, and how they're invested, the custodial operations, and all the like. All that has been defined clearly. Ensure that whatever we do is within the confines of the law, and the standards which have to be adhered to by any scheme operator must be enshrined. And therefore, that gives us a weapon upon which to enforce regulatory compliance, because the standards have been set and you're supposed to adhere to them. The second level is more of governance. Governance, like I said earlier, this is entrusted with the boards of trustees who shoulder the fiduciary duties, but they must have a license. That's an entry point. And I've already shared with you the numbers we have of trustees, but also have individual trustees and corporate trustees. Many have been licensed, and actually our licenses have helped some people to grow professionally, because having a license of URBRA as a trustee raises your credibility and subsequently has added value to many of the trustees in our market. But we also demand for strict member representation on the boards of trustees. You're a member, you must be represented. Whereas the structure may be driven largely by the employer for those that are occupational, but where they're not even occupational, a member has a stake because you are the holder of the funds, so you must be represented on the boards of trustees. Because of the capacities that we had in the past, we made it intentional to build their capacities, and we introduced the trustees capacity enhanced program, trustees training, which largely helps them to get at what is required of them, understand the legal framework, and also review, understand what they need to look into in terms of that may be shared by the service providers. It's very, very critical that they understand and also appreciate what they need to look into. But we've gone ahead to set the investment caps. This one is also intended to ensure that I'm looking at the policies that have come. These policies again speak largely to the member. The process of interest declaration. Remember how you fared, and that's why we demand for every year there must be an AGM. That is the requirement. That is an annual general meeting to show the members how it's basically accountability, a feedback, how your scheme has performed. But there are also other policies that we've demanded that must be in place. Risk management, that means must have a framework within in-house that adheres to that. And again, evaluation of the trustees. It's not that you are appointed as a trustee that it should end there. There's a requirement that trustees must be subjected to an evaluation to ensure that you are performing your duties in the interest of a member, but also you ensure that everything you do is at arm's length. There's no conflict of interest. There's a requirement for a policy on conflict of interest. All those are intended to ensure that the governance level at the helm of the scheme, there is that arm that is very, very strong. And the regulator enforces that from the beginning and subsequently continues to monitor it to ensure that there's transparency, accountability, but the ultimate objective is to ensure protection of members' funds. The third layer is on the enforcing prudential investment. And again, here we are looking at those licensed fund managers that I mentioned of earlier, who have to meet certain standards, that their directors have to have a standard of professional proficiency, competency in fund management, and evidence of having trained in this field and subsequently integrity. So there's a requirement to confirm to us that that the board of directors of those fund management firms are of good standing. The second area is a standardized investment policy statement. This is an investment strategy that each scheme must have. So the regulator must look at it, review it, and then give an objection to it before it is implemented. And that's why you see the investment returns are very good, because they're invested in those asset classes that have been guided and directed, and subsequently manage the issues of concentration. But you may realize that for those who have been following closely, most of the schemes, there's a concentration challenge. Most of the money is invested in government securities in our market. The beauty is that it's the biggest earning investment class at the moment. Of course, you would understand that dynamic, but that does not mean that fund managers should focus largely on that and not be able to look outside that box, see where the money can be invested better. So we demand, and that's what the regulator does. I've talked of the caps that we set, largely to define not how much, that's a dictate on the volume, but on the percentage limits, that one we define. Largely because we've read the market, we know how risks can be spread, and subsequently where the minimum risk can be, and then we advise on that area of concentration. But also continuously monitor this. Like I've said, some of the schemes have actually overinvested, over-concentrated their money in the asset class, but they have a duty to request the regulator to allow them to, and that has to be followed. If you don't adhere to that, we sanction, we penalize, and subsequently we can even suspend. All this we do to ensure that there's prudent investment of members' funds and subsequently sustainable returns that we all talk. I think we've had double-digit returns for the last 10 years. And today I think last year we had those that were very rosy for everybody, 12, 13. So the double-digit for consistently 6 years, it's a very, very good attribute. And if you look at the real return, that is 7+, that is a very, very good effort. And we can say that there's very good compliance, very good adherence to the prudential investment requirements, and we are very proud of that. But there are also those in-house things, the operational efficiency in the schemes. Again, the regulator dives into standardizing who is the administrator. Do they have a license? Who are they anyway? Do they meet the minimum requirements? And do they have a robust system that can be used to serve the population? The financial reporting standards, we have adopted the international financial reporting standards, but we've gone ahead to articulate those that speak to us, and we've set clear regulations and guidelines. The case in point, in our market, we've guided on the valuation of assets, particularly the government assets. There's two methodologies, but we've adopted that does not allow speculations. There's mark-to-market, but we've adopted the one that actually looks at how the yields come into play without really bringing in the volatility of the pricing. So we've guided on that, and we see significant adherence. And why we are doing this, we don't want interest to be declared that has not actually materialized. We don't want to overinflate, to over-recognize interest that is not realistic. And that's the reason why we've come strongly in terms of those reporting. But again, because of the financial excesses of many of the trustees, of many of the schemes, there's a clear requirement to disclose all the costs in the scheme, how the money is being spent, and even how the trustees are remunerated, the money that is spent to the trustees, and even the fees that are paid to each of the service providers must be disclosed. And subsequently, we go ahead and be able to make an assessment and guide accordingly. We approve external auditors, very, very critical. These are people who have the eye where we are not. They first give us their opinion and we trust that. That's why they must be approved by us. And where we have cases with any of the auditors, we raise the concerns to the Institute of Certified Public Accountants of Uganda, and some have been reprimanded for giving false audited accounts. These are details that we go into, and that's what happens in the kitchen where we are. But also go ahead to publish these returns to showcase
Okay.
Can you hear me? Was I lost?
The screen, yeah, your screen got lost, but you're back on. The screen is not yet back on, but we can hear you.
Okay, let me share it again.
Okay. Can I project the screen for you?
No, I've got it.
Over here?
I've got
Okay.
it. I've got it.
Okay, it's back. All right. Yeah.
You can see it? Perfect. Okay.
It's back.
So I was largely on the scheme operational efficiency, and we are looking at the publication of scheme returns. We summarize this report and we disclose the performance of each of the scheme. It's not that we want to shame some, probably we can improve on our reporting, particularly with the clear distinction of DBs and DCs, the requirements of a defined contribution scheme and a defined benefit scheme are different, and therefore, where returns matter for a defined contribution scheme, they may not necessarily matter for a defined contribution scheme as long as the promise on how the pension shall be paid is honored. But by and large, we attempt to disclose these returns, we attempt to disclose the costs embedded, and provide a comparative analysis such that a member out there can be able to distinguish and be able to ask those questions with their scheme after having shared a standardized way. So we also go ahead and look at the interest declaration. Here only show the comparatives, again, not to underscore those that have not declared higher interest than others, but the principle is we are trying to create a platform where members can ask those questions. Why did we get low returns, yet others declared higher returns? And largely, such that the trustees can explain. Normally, this happens or is largely informed by where the money is invested and also the cost efficiencies, which we push and which we are trying to articulate in terms of transparency. And the overall objective here is to improve the operational transparency, efficiency, and help members and trustees make informed decisions. Statutory returns, this is a regular thing, and we see very good compliance. We use this information, but also to share where we're coming from. In the past, we are demanding for annual returns. Today, we are looking at quarterly returns. We are diving into monthly returns, and then as we advance our capabilities, we shall also demand real-time returns and operations. But we may also appreciate the transitional transaction and settlement in the sector, where an investment is done or a payment is done. There is a lag of time within which to settle, but we are demanding at some stage, we shall demand at some stage for a frequency and more timeliness in terms of reporting. We penalize for mismanagement. In the event that there is non-compliance, we sanction. We've introduced by the penalties. Remember, we are in our 14th year of operation. So I think the first 8 years have been more of babysitting, trying to grow the sector. But I want to commend the schemes that have really adhered and complied. The compliance levels are extremely high. But where there is non-compliance, we now penalize and sanction. Largely, they want to promote that requirement of accountability, and to know that if you don't perform to the standards set, we'll penalize you. Misconduct is not in our space. So if there's any mismanagement and misappropriation of members' funds, we really take it seriously and we sanction. All this is intended to preserve the quality and integrity of our sector, to protect and to give the assurance to the members. As you may realize, most of the things I've mentioned above, many of them in the past were paper documentation. File your application through documentation, we follow up, we monitor, but we've also advanced in our capabilities in-house. So today we are in our fourth year of our risk-based supervision system tool, which is growing strong. We are enhancing its capabilities. It's actually one of the best systems in the region. Currently, it has been developed in-house by the brilliant people at URBRA, the professionals who have been very articulate, because we know what we want, we know what we want to try and solve. And because of that, at the back of our minds, we've been able to come up with a very, very good system that is now being benchmarked within the region as one of those very, very good systems. What do? We collect information in real time. Of course, real time is probably an overestimate. For now, we are getting information quarterly and use that data to do the analysis. But that does not stop us from capturing information that is happening in the market in real time. The macroeconomic fundamentals, where the money is invested, we follow that one on a daily. We know the concentration of our money, where it is invested in fixed income assets. We follow up on each of the equities where the money is invested. We follow the trends, and we can be able to detect and be able to give clear insights of what it means to the members' funds and what size of impact it can pose, and subsequently be able to guard against any risks that may materialize. So we think we've built a modern system that's very robust enough, but also enables us to have a capability of continuous improvement. And that's the beauty of it. We think we can be able to have that system that we can galvanize and be able to quickly be able to detect risks in real time. Largely, that speaks to what we do in terms of oversight. I've summarized it through those layers. So what has that helped us? Some of the results, I mentioned the volumes in assets under management, but you're also doing very well. I've picked a few sector trends that largely speak to you, a member. The levels of contributions are greatly improving. You can see numbers before the 2018. Actually, we had figures of less than $1 trillion in the early 2014, 12, thereabout. But you can see the numbers are almost doubling $1 trillion from 2023 onwards. That means there's trust. You've actually built that trust and confidence in the sector, and you are saving more. But I also attribute this to the employers who are paying you well, because remember, most of this money is a function of the salaries that you get, and this speaks volumes. But I want you to look at more on the returns on the investment income, which has exponentially grown from as little as $1 trillion in 2018 to $4 trillion in a space of 6-7 years. You can just imagine the effort and the work. One would argue the macroeconomic fundamentals have been very good, correct, but you also need to understand that the money is invested in those allowable asset classes. Fund managers are playing a great role, very prudent investment, such that we are having these investment returns, which is very, very good. And that speaks volumes to what we do. But it's also important to note that benefits have also started to grow in terms of payments. The intention is not to show that the benefits are growing. More to this is more the efficiency, the time it takes for investments to be paid. We've seen great efficiency in the turnaround time within which people are paid. It used to take quite a long time, 6 months, 3 months. These days it takes 2 weeks, but in some schemes which are very, very efficient, a week, 5 days. All that is efficient. And the costs embedded into the operations have also significantly reduced. That's the efficiency. So we also have challenges. All is not good. We cannot bury our heads in the sand without stating what we are also challenged with and what we are focusing on. The pension coverage is very low. The amounts of assets under management that have shared, that's the 35 trillion or the 36, is actually owned by 4 million member accounts. The member accounts here, we are talking of those who are even in the occupational schemes and NSSF. So there is a multiplicity of ownership. But by and large, it is owned by a population that is not large, to be precise, a smaller population, against the working population of 18 million. And that speaks volumes on what we need to do to look into that uncovered population, which is largely informed by the informalities of the labor markets. But we are set all our energies into that. And I think in the next 2 years, we should be able to give you the results of our efforts, which I'm very optimistic will be very good in terms of coverage. But we've also noted that the income that is being paid is not significantly big. The statistics we have, members who are registered in our sector, in our market, have an average of less than 10 million. That means that even if you wanted to introduce a pension arrangement, the base is not so big, but that shouldn't stop us from starting the conversation around it, in order to see that we allow members to have a continuous cash flow beyond the lump sum payments. You've seen the risks of people being paid lump sums. Money is wasted in the first 2 years, and subsequently, we fail to contribute to the biggest problem of this country. That's the old age poverty, and we need to deal with it. And that's why we want to, please, when we approach you to start this conversation, understand where we're coming from. But we shall be having a specific conversation around this. And I think some of our webinars will be specifically into this and more. The third challenge, I think I've articulated to this, is investment concentration largely in government securities. Yes, you've made a significant contribution in lending to government and you've supported quite a significant volume. But what we are trying to push, apparently, I think members want to associate with a successful project. And the current conversation is to see how these funds can be aligned to a particular infrastructure project for ownership and to have pride into it. But the risk is still there, the concentration, that your money is still invested in one of those asset classes. The emerging risks that we are grappling with, as we dive into deep automation, the digital world, again, we are exposed to cyber security threats. So the team around has to be very mindful of that. And that is not necessarily within the regulator side, but even in the schemes that we regulate. They are deeply automated. Services are largely digitized. So, and the risks are also imminent. So what we are now looking at, how have you galvanized your systems, your operations against the cyber security? There's also a significant demographic shift. There's a growing number of people over 60 years, and many of these don't have any cash flows, so it's a very big challenge. We also know that there's quite a significant number of the current so-called middle class who actually hold a significant amount of money of the 35 trillion that I've talked about, that are 15 to 10 years and above. So in principle, there has to be a clear plan for them as they arrive at the retirement age level when the basically well prepared. We think that's a very critical consideration for us. And of course, the macroeconomic fundamentals. We've had very good stability in this country from the macroeconomic perspective, and that has largely informed the rosy returns that we're talking about. But also monitor where our money invested in the region at large, and we monitor the trends there to be able to provide that comfort of investment. We are also mindful of the climate-related risks. We are preparing one of our documents or that a guideline on investing in ESGs. So we think we can be able to launch that one for you to understand where we're coming from. But the principle is that we need to be mindful of where the money is invested and whether it is consistent and in compliance with those fundamentals of ESG. So largely, that's what I had to share with you, and I'm ready to receive any comments, any reactions from you as we dive into how we protect, how we prepare the meal that you've already seen in the media and many publications we've read. I thank you for your attention. Over to you, Lydia.
Great. Thank you very much, CEO, for such an insightful and informative presentation. And it has already answered most of the questions that we came here with. Many were wondering, what is URBRA? What does URBRA do for me as an individual saver? Is URBRA a saving scheme? How can I start saving with URBRA? Who funds URBRA? Questions like that. I think by now many of us have got our answers. Nevertheless, we still have questions that are coming in on our socials and in the Q&A chat. Ladies and gentlemen on the call, kindly use the Q&A chat to drop your comment, your question, your compliment, your complaint, whatever you have to reflect on the presentation that we just partook as delivered by Mr. Suruga. But I have a question. One of the questions that came in already is from Mr. Mukulu, and he says, does URBRA set benchmarks for the sector, like minimum interest rate, cost to income ratio? That is Mr. Mukulu wondering if we have benchmarks regarding interest, regarding cost to income ratio. Earlier on, before we even started, I had a question, and it was really coming from a typical saver who wondered, why do we think that they are incapable of investing their money? Why are we investing their money for them? Who says they'll consume it? Why can't we just let them have their money? You know, that was one of the questions on our X account. And another person again was wondering how URBRA can help her to access the benefits of her deceased husband. She has been trying to access the retirement benefits of her deceased husband, but she has not been successful. How can URBRA help her? Again, another one similar was asking how URBRA can facilitate him or her to access their savings, even though they have not yet made 55. There was a question about formal employment, which you articulated on, but maybe you'll add some more light. This person was wondering that if they are not formally employed, how can they participate in retirement saving schemes, although they are not formally employed? And then one was asking about the money invested in the region. Don't we need it more at home than in Rwanda and Kenya? And then another person asked if schemes need permission from URBRA before paying them members their benefits. does a scheme require permission from URBRA before paying benefits to a member? And then there was a question on reducing the cost of administration, and somebody specifically said that you have mentioned URBRA applies the arm's length principle and segregation of duties. Doesn't that increase the costs of operation for schemes? And finally, there was a question on how URBRA is addressing ESG and climate change challenges, which you ended with. Those are the questions that I have for you, Mr. Nsubuga. Members, if anyone has more questions, feel free to post them in the Q&A, or feel free to raise your hand and I will see it and I'll select you and I'll unmute you and you will make your voice heard. For now, those are the questions that we have for the CEO, and I'll invite him to respond to them at this point. Over to you, Mr. Nsubuga.
Thank you, Lydia, and thank you, colleagues who are online with these very good questions, which to me reflect that you've been with us for a long time and you are asking the right questions at the right time. I'm not shy to say that in the past, we would never get questions of this kind. So to me, that is a level of satisfaction of our impact, and people are asking those direct questions, which show some degree of enhanced understanding of the sector. Let me begin with the first one. We set benchmarks for interest declaration and cost income ratios. The answer is no. The regulator is not, in a good practice, is not in order to set these standards. However, what a regulator does is to disclose the performance of how interest has been declared across all schemes, and also go ahead to show the average performance. The intention is for the scheme members to see whether they are above the average or below. And if they are below, to pose the right questions to their trustees. But the most important thing, it also helps them to understand better. Where is this money invested? Why is it that if you're investing in the same asset classes, we are getting different returns from others? Those are questions that are beginning to come up. And to us, that shows a degree of understanding of the market by members. The second one, cost to income, again, we don't, but we disclose the current trends because we enforce efficiency. We discourage excesses, and we are mindful of members' funds not to be wasted in things that do not add value to the member in terms of returns. But that does not mean that we set the minimum, but apparently we disclose, we show. I think apparently today it's around close to 1% on average. But if you remove the largest one, it's between 2 and 3% largely. So that also speaks volumes in terms of efficiency. We are coming from a double-digit costs to income ratios. But if you're at this level, that is fair enough. But we're also very mindful of not setting these standards because we would go into another price war of undercutting with the service providers. And I think that is not very good for the market. But yes, we would probably look into, particularly on the cost side, basically not to dive into a price war, which can impair the standards. So we are very mindful of that and we're working towards that. The second one, why are we not allowed to invest our money? Are we not capable? It's not that we are not capable, but if I asked you if you are not forced to save in any of the mandatory schemes, would you save for retirement? We've run that quiz always, and to our surprise, many people have answered a no. Because they because they want the money today without not looking at what would happen in future without this money. So the idea is we allow you a big chunk of the money for you to play around with. That's why you only save 5% of your salary. Even on your employer, only save 5%. So you have the 95% with you, which you can deal with. So I still think it's not that we are not allowing you, we are actually helping you to help you to have a backup for your retirement in the event that time happens, but also to grow a portfolio that will support your cash flows. One who wants to be helpful to recover money for deceased husbands, I'd not talk about our complaints bureau. It's one of our interventions, a very good platform. Kindly come to us. We are ready to support you. Come with more details, the name of the scheme, where your husband was working, and subsequent, if there's any documentation you have, it would be very, very important. But to also encourage you to reach out to the trustees of the scheme where your husband was working. Normally, they have better information to that effect. We enforce delays in payments with support where people have not been helped, but also encourage you to first begin from there. Probably you've not approached them, but in the event you've had serious frustrations there, the regulator is very available to support you. How do you facilitate access for savings for people who are not yet 55 years? There are different windows to that. I will speak to the, I think the NSSF Act, they introduced the midterm access. There are also some restrictions to that. I think you must be 50 years and above, there about, but you also must have saved some money for a certain period of time. For the occupational schemes, the same approach has been encouraged, not encouraged, but supported. But the idea is not to facilitate a drawdown of that money before you are at that age. The framers of this law and the insights of the market was that at the exit employment, your employer is more interested to see you having a good reputation of the good services you offer to them. And that's why they go a step further to save for you into NSSF 10% and also another scheme, which is an in-house scheme, such that at the point of retirement, you have a buffer to look after you or to fall on to. So largely, the idea is not to encourage to access it before, but the mechanisms to allow you get a minimum amount, I think as not more than 20% is already embedded in most of the trust deeds. Work on the formal employment, where can I register? Yes, for you who is in informal employment. First, you can go to NSSF. I'm not marketing for NSSF here, but you can. But there are also other voluntary schemes that we've licensed. If you went into our website for URBRA, we've licensed many umbrella schemes where you can go into as an individual and register and start contributing. And they're also, I'm talking about umbrella schemes. I said they're around 13 in my presentation. You can reach out to them. And thirdly, there is an individual voluntary scheme you can go to, and that is Mazima. The addresses and contacts of all those is readily available on our website. If you cannot access the website, please reach out to us. We can support you. Why is our money not, we need this money in Uganda, why is it invested in regional across? And your major reference was Rwanda. This is governed by the legal framework. You may realize that the Act allows for investment in the region largely, and that's the East African region. It was very, very clear. The issue is to allow a wider scope of investment. There are times when there are very good returns. In Kenya, the Safaricom investment, very rosy. And I think it was wise for any prudent investor in Uganda to invest in Safaricom. Those who did gain significantly. Of course, the time when there was an exchange rate the appreciation of the Ugandan shilling against the Kenyan currency. We had serious issues. You know what that meant to us. But the issue is, we cannot stop that because it is enshrined in the law. But that's the work of the fund managers. They use their professional competences to know where to invest. The idea is to maximize return for the member, but also to protect you as a member, to ensure that not only the money is invested, but is protected. Maybe the question would be, is that money safe in Kenya, Rwanda, or otherwise? Yes, it is very, very safe. Do you require permission to be paid your benefits? URBRA does not give permission to that, but we demand that you must have a policy on benefits payment, which clearly stipulates the process. So it's your right to demand for benefits payment from your scheme. You don't need even approval from us. Demand. In the event they've not honored your request and you qualify, then come to the regulator. We know what to do and we shall ensure that you are paid. Segregated responsibility, doesn't it enhance costs to the schemes? Yes and no. I think you are largely looking at the cost, but you have not looked at the value. I prefer largely to look at the value that is being brought to the table of the segregated functionality and spreading of the risks. You have a crop of professionals, the fund managers. You also have the custodians who provide the custody and who settles these transactions, again providing the assurance and keeps your titles of the information, the titles of the assets and the money, and then the administrators who provide the professional work in terms of running the scheme. If you've opted for an in-house administration services, that is pretty okay. Maybe the most critical point is for us as where we sit as the regulator, and it was a subject of discussion. And I think it was largely attributed to the fund managers who are investing largely in government securities. And the question was, does this require a highly professional person and the costs we pay? The debate was there. But to make a decision to invest in government securities is also a process. You'll have to look at the market. I think I've said of the macroeconomic fundamentals and the dynamics embedded, but that does not replace the fact that, yes, they could probably do more and looking at other alternative investments that can provide probably even better returns without compromising the protection of members' funds. But the segregated functionality is very, very important in terms of value to the member. On the cost side, I think we've shared the cost-income ratio. The ratios we share actually include the fees paid to the service providers. They're not significantly high. And that's why I raised the idea that we need to be mindful of the price war that could be dictated by the undercutting, and then we dive into another layer of regulatory concern. I think I've dealt with them. That's fair enough. Lydia,
Yes.
over to you.
Thank you so much. And it looks like the more you explain, the more questions we get. But anyway, there's a few more questions that came in, and they really look like a follow-on to what you explained earlier. So I'll just raise them, just one or two, really. And yeah, our time is coming to its end. We have another 15 minutes before we end. But let me ask this one, which Mr. Chemonges brought in, and it was about the investment of funds. You talked about the investment in East Africa, and he was wondering if URBRA is considering opening an opportunity for offshore investment in markets, like Mauritius. And then he thanked you for the insightful presentation. And then finally, Mr. Grace or Miss Grace Kigenyi wondering, is it allowable for a member who is leaving a scheme to leave his or her benefits behind at will if they have no immediate use for it? If so, what is the procedure? Those are the extra questions that came in, and I'll let you respond to them before we can start concluding our engagement this evening. This morning. Over to you, Mr. Suga.
Thank you. Quickly, offshore investment is a valid observation. When we were pushing for this law to be passed in Parliament in 2010, 2011, there was no limitation on where to invest this money. But the members of Parliament, in their wisdom, and I'm tempted to think they're probably right, to invest the money in the region. And I'll give you the reason why. They're more looking at having the money locally available for the region, for the investment. But also the few, the push for offshore investment is a very good idea, but we also pick from Kenya who have advanced into that space. Kenya had a model like ours, investment, local region in East African region, and they opened to the offshore investment, I think 5 years ago. But I can testify that the absorption, whereas they gave a headroom of 15% investment in offshore investment, attraction has been, I think, less than 5%. I think to be precise, it's around 3.5% investment in offshore investment. The main reason today is that the region has been providing very, very attractive returns. For any prudent investors, that wouldn't make sense. So, but that does not mean that the window of offshore should be closed, the Mauritius and the like, but that has to be dealt with through the legal framework, amending the Act or other methods of investment through structuring of an investment, and probably having a domiciled principal investor localized here. The fund managers know better how to do that. But yes, for now, it is limited and it requires a lengthy process. Is it wise to do it? We can create the window, but I can confirm that the attraction may not be as many people have anticipated it to be. The attraction is still poor. Leaving your funds behind when you are exiting, it is in order if you are allowed. If your trust deed does not provide for that, we are willing to support you to amend the trust deed. Like I said in my earlier objectives of the pension reform, adequacy was one of them. And we believe the longer you retain your money, the more it grows, the better it becomes. But besides that, if you don't have what to do with your money, it is safer with a scheme that you are apparently working with. The framework is very strong and tight, and it can provide you with that certainty of your protection of your money. And to us, it gives you the confidence and trust. I think that the trustees of that particular scheme should be proud that one of your staff or member is willing to even keep their money, even when they're about to leave. They say, please, me, I'm okay with my money staying with you. You are doing a very fantastic job to provide that assurance, to provide that confidence, and that's what we articulate significantly from our side. Thank you.
Okay. Great. Thank you so much, Mr. Subuga. There's a lot of flowers for you. I see a lot of thank you, Martin. This is very insightful. Thank you so much in the chat. But there's one that I will not allow to just go unread because it is a key concern. How should we address the risk of, no. It is a request to URBRA to intervene in the local government pension arrangement. The arrangement is unfair and has many loopholes. The retirees from local government are not receiving their pension money monthly, and they are not even compensated or paid arrears for the months that they didn't receive their pension. Yes, that's a very important complaint from Miss Fiona Mutamba. Mr. Nsubuga, would you like to give the assurance
Yes,
to Fiona of how we can support
yes,
them?
yes. First and foremost, I want to thank everyone who has given us the compliments. I've seen the many thank yous. Yes, thank you. I also returned them. I'm really very grateful for the compliments. It shows that we're doing a very good job and we're impacting lives, and that's what we stand for. And all the energies and efforts that we put in place for the last 15 years and even the reform process of drafting the law are yielding results and the confidence that we are proud of today. Thank you. Now, for the Fiona, yes, it's a valid observation. And government has amended, introduced a law, that's the Public Service Pension Fund, which is going to be a standalone scheme. And the main objective for it is to address some of those issues. And the first entry point is to be able to clean up whatever is happening, to be able to have a clear record of every member, and subsequently be able to cure the occurrences of that kind of issues or concerns. The Ministry of Public Service would become operational come next year, 1st July. But the beginning point is to put structures in place and to be able to organize or reorganize and be able to do the cleanup, standardize, and subsequently bring everybody on board before contributions will flow in. I'm told contributions will flow in the financial year that would follow or later in another year. But the focus apparently now is to put everything to order. So your concerns shall be addressed. What I want to request you to be ready with, all the documentation required to ensure that as they do the onboarding and migration into the new fund, you have a clear documentation available and you are not left behind. But in the meantime, please, you can raise a complaint with us. We can be able to support that because before even the Public Service Pension Fund came into place under an act, the regulator was in place. So we are readily available to support you. Lodge in a formal complaint with all the necessary documentation, and we shall see what we can do to solve the matter. Thank you.
Okay, thank you so much. It gets more interesting because it seems your responses attract more comments, and these ones I'll let you read for yourself. They are concerning Kenya and its offshore experience, and they're in the chat as you can access. But in the meantime, when you speak to those comments, Mr. Nsubuga, I think then we'll start bringing this to an end. We are concluding this, and from you, the main presenter, the leader of URBRA, the regulator, and therefore the main man in overseeing the sector. What's that one thing that you'd like us to take away from here? That if after all the listening, that one thing that you want everybody to go with and stay with as they wait for our next monthly webinar. I'll let you read through the comments very quickly and give us that concluding takeaway, and then we shall close the engagement. Over to you, sir.
Okay, thank you, Lydia. I think this one is coming from Paul Chene. Paul, your concern is I mentioned about Kenya and what is the experience in offshore. I think I did share that. Kenya introduced offshore investment, I think 5 years ago or close to that, but the attraction has been low. They have a headroom of 15%. The attraction is less than 5%. I think it's around 3.5%. Why is it not very attractive? I think any prudent investor would wish to invest their money where there are huge returns and certainty and protection of members' funds. The local markets today, the government securities provide that certainty. The returns are very handsome. And protection government securities, all the literature around confirm that investing in government securities is the most risk-free investment vehicle. That's what it is. Of course, depending on the fundamentals. In Ghana, where that concentration was, when there was when the government decided not to pay, Ghana had serious problems. We don't anticipate that because of the prudent debt management policies in the government of Uganda. And I think we are doing very well at that. I want to thank you, all of you, for, first of all, always participating in our webinars. The feedback we get is very, very encouraging. The questions you ask to us is clear feedback and testimony that you are steadily understanding what you do, and you are in very strong position to ask the right questions, not only to your trustees, but to us as a regulator. And I thank you for that. I want to thank my colleagues who have organized this, Lydia and your team, Haji Hassan, Billy Gang, Lydian, all the team in the Corporate Affairs Department. Thank you, the team at URBRA. And I want to thank each one of you who have really made this possible, and our board members who allow us to perform and to work. I commend them for the work they are doing for us, and I want to pledge that we shall always do the best for the sector and for the members out there. In the next webinar, I think I just want to assure you that your money is protected and safe. It doesn't matter how long you keep it. The vehicles in which it's being invested are regulated and monitored by us, but also need to think through beyond accessing this money. The focus seems to be largely on accessing the money, but has not been a definite solution on and then what. I commend NSSF's work in the journey to have people being trained on how to use their money, despite the challenges it has, but also know that there are not so many people who have lived to that level. The majority waste their money. So I want us to start thinking of how can we allow the money to be invested by professional and just get a little out of it, spread the amount over a period of time. What we are trying to push, and that's the conversation that we are going to have in the next webinars, how do we introduce the conversation of seeding the lump sum payments to a spread payment, say a program withdrawal of some sort, or even partnering with the established framework of annuities, that's the insurance side. As long as it is consistent with our aspirations, controls are in place, disclosures are very clear, and there are no hidden costs like we saw the litany or the literature on annuities of the past. The annuities of the present I think they're much better, but again, you must be pretty to understand them. So that's the conversation I want to see. The idea is that how do we tackle the challenge of old age poverty? Is lump sum payment a solution to old age poverty? We've come to believe that it's probably not, and we need to be seen doing a service to the population and to you members. How do we articulate the problem of having a cash flow in retirement? So with those few remarks, I want to thank you once again. And I pray that God continues to protect you and to guide you and to lead us in whatever we do, and that may our works always be pleasing to God Almighty. I thank you for your attention.
Thank you, Mr. Nsubuga. And we're going to close with a vote of thanks and a word of prayer from Hajati Seviala. Mama Environment is going to have the very last word to wish us a good weekend and to wind it up for us in the last 1 minute remaining to 12:30. Hajati Seviala, please give us the last word as we go away from here. Your hand was up for a long time. I missed it, but let me give you an opportunity to say bye-bye to us. Hajati, over to you. You can unmute.
Thank you very much, Lydia. Do you hear me, Lydia?
Very well. We hear you very well.
Great, great. Thank you so much. Thank you so much, Martin. Thank you so much. I should not ask my question because we're closing. You have asked me to say a prayer. But I'll leave the question there for Martin to ponder. That is the challenge that you had of the challenge of AI. I should call it AI. I want us to look at it as trustees. Where should we have the sharpest eye that AI can touch the funds of our savers? But I am a trustee of Mazima, and I thank you for this opportunity. Can we pray? Lord, we thank you for this day. We thank you for URBRA. We thank you for the talk that we have just heard from the CEO of URBRA. We thank you for the excellent moderating that we have heard from Lydia. We pray, Lord, that whatever has been taught to us today, we are able to implement as trustees and other service providers. We pray, Lord, that in the closing statement of Stansubga is talked of old age poverty and how that can be handled. And this is going to come in the next talks from URBRA. We are looking forward to see how we can overcome old age poverty so that the savings that we have today, we are able to make meaningful living when we are into retirement. We thank you for the gift of life, and we thank you for everybody who has tuned in today. We thank you for all those who care about their retirement, Lord. And we cannot forget to thank you for everybody at URBRA who are guarding against a loss of whatever we save and all those things that have been enumerated today that they do. We really thank you so much. And in glorification of your name, we have prayed. Amen.
Amen. Thank you so much for your participation. Just that I didn't see their hands. I'm sorry. The icon did not come on my screen. But Francis, please let's take the conversation forward. Thank you and have a wonderful weekend.
We go through life doing different jobs to make ends meet. No matter how strong you are, age will eventually